So welcome back, everybody, here in the room in person in Frankfurt at the DVFA Center, as well as online. I hope you had a nice lunch break. And I also know that starting on time after the lunch break is always hard, but therefore we picked the right topic, a real practitioner topic. So therefore, I think you are also eager to hear how we can combine ESG and the strategic asset allocation for multi-asset funds. And I think this is really the name of the game in the overall asset management area, because in the past, we were always looking from bottom up. How do you handle fixed income? How do you handle equities and the like? And here you get a rather top-down view, how you can incorporate the overall idea of ESG into your strategic asset allocation process. So, and for this reason, we are glad that we have my colleague from DWS here, Dr. Gunnar Friede. And Gunnar is head an ESG for multi-asset and solutions at DWS Group here in Frankfurt, and senior portfolio manager. And in this respect, he belongs to the real pioneers in this business at DWS, because he started with it in 2005, when we already launched the first funds on the global scale, introducing ESG. And besides that, he is member of the EFFAS Commission on ESG, and also co-chair of the German DVFA Commission on Sustainable Investing. And as far as the CESG program is concerned, what we heard from Fritz Mosberg at the very beginning, and which we will hear from Professor Bassen in a while, Gunnar was also at the very first part and from the very beginning active there when the 5 founding members set up this program in the early 10th of this decade. So, I mean, he's with it for more than a decade now. And I think with this background and the practitioner's view, I think it will be pretty interesting to see, Gunnar, what can we learn from ESG in the strategic asset allocation? Please go ahead.
Hello, everybody. Many thanks, Frank, for these kind words. So the bar is high now after the lunch break. Hello, everybody here in the room and also online. So it's my pleasure to talk to you about the ESG integration in strategic asset allocation. And as Frank just said, this is not so much a bottom-up view, but today more top-down view. And the big question is, surprisingly, why haven't we heard so much in the past about ESG integration in strategic asset allocation? Because for me, it's still surprising seeing that we are still in a kind of infant phase when we are talking about ESG integration in asset allocation, because surprisingly, also this is what PRI a couple of years also told us. And 2 years ago, they made a huge exercise and also invited a lot of asset managers to contribute. And what they said is even 1 year ago that surprisingly few solutions are available compared to the practical relevance of ESG in asset allocation. So why is this the case? And let us go through some points here that we have prepared. So they are basically for practitioners in the past 2 approaches, how to integrate ESG aspects into the broader asset allocation perspective. And the one was just mentioned by Frank. It was primarily bottom up. It was bottom up because what typically is done by investors, even for large portfolios, you are taking your specific ESG restrictions and implementing it from a bottom-up perspective into the portfolios. So meaning you have the various portfolio restrictions, ESG exclusions, and then you do this incorporating it into the portfolio. So this is very individual, but obviously this is only can be done for large institutional investors. On the other hand, what is the consequence for the tracking error? This is more or less determined by the ESG restrictions that you have chosen. And you see here, hopefully, what we want to tell with this graph, and also here with some words attached, that in the end, it is relatively fair to say that we have a lot of degree of individualization for such kind of approaches, but unfortunately, it's totally unclear whether we have an ESG optimum or a financial optimum with integrating really specifically from a bottom-up portfolio perspective. And last but not least, of course, it's not scalable at all because it's only individual. It's done for various investors for the specific criteria, and it's really only step by step. It's hardly repeatable for any investor. So scalability is a huge issue. On the other hand, if you are a smaller investor, then you have the second approach. Typically, you can switch to, let's say, ESG indices or ESG ETFs or active funds. And then, of course, it's not so much with the degree of individualization that you can choose your own criteria to integrate and your own set of, let's say, also best-in-class criteria you want to use, but it's more or less a consequence of what you can choose from the market. And again, it's not quite clear with regard to the, let's say, degree of optimization, degree of ESG, let's say, optimization with regard to the financial perspective. So to make a long story short, for me, that are the two basic approaches for large investors that are typically taken. And what we propose now is a, let's say, an additional approach, how to deal with ESG aspects from a asset allocation perspective that can also then be implemented also for smaller and on the other hand also for larger investors. And this is an SAA, a strategic asset allocation approach that really takes into account the ESG aspects from various different angles, and on the other hand optimizes it against the tracking error. So with regard to your active risk compared to a kind of asset allocation perspective. And with that, we can, I would say, for the first time say with relative confidence that we can find a kind of, let's say, optimum between the financial and the ESG aspects at the same time. So a combined financial and ESG optimum, where I always, as a practitioner and also as an academic, quite interested in to find such a balance. And for me, there are unfortunately not so much solutions out there. So let us spend some time what we have done there, and also later on what are the plans also to further roll out these methods and how it is scalable. Why haven't we heard so much about other ESG integration into asset allocation before? So there is unfortunately a lot of complexity which you have to deal with. It's about not only the ESG data availability and look-through the indices and so on and so forth, but it's also a question of the tools that you need in order to make not bottom-up optimizations, but top-down optimizations. So strategic asset allocation needs to be in place. And last but not least, it's also important that you have not only the rear view, but also a kind of more forward-looking view. And this is what we have in-house with the so-called DWS ESG long view, which is an estimation model for more than 200 asset classes, and where you have a kind of forward-looking perspective for many different asset classes, where you not only optimize backward-looking, but also blended with a forward-looking perspective. And this ESG long view approach considers then something like the income perspective, so be it dividend, be it the coupon, be it the valuation, and also the growth of this in the past and for the future. So what brings this now together is a set where we, I would say for the first time, also for smaller portfolios, which is really important, can individualize quite a lot with regard to the ESG integration into asset allocation. And we can also find a kind of, let's say, combined optimum of ESG aspects and also financial aspects. And you will see that we have many different facets when we are talking about these ESG things in detail. And again, what's really important, it's not a bottom-up optimization, but it's a top-down optimization based on ETFs or available indices. And this makes it really so unique because it can be applied in the end for everybody and for every investor, and not only for specific investors. So what we do there is we define on various risk parameters, we track it in our engine from various different angles. What we have chosen is to say the tracking error is against our reference universe is the most important comparable metric, because this is for us insofar important as we can say for every, let's say, additional active risk that you have, what is then the additional ESG value that you get on top of this and how it relates to each other. And the reference universe that we taken for this analysis, and it can be totally scaled, is a 50-50 reference universe. We have 50% global equities measured by the MSCI All Country World constituents, and we have a 50% weighting for the bond universe measured as the global Barclays multiverse index, so the most let's say the most comprehensive bond universe with all the different sub-asset classes. What we then do is to define, let's say, various scenarios in order to then say at which angle we are looking at this. And we have defined here, for the sake of simplicity, 4 scenarios, like where we do some kind of basic optimization, so that you want to reduce, for instance, the norm violators or the poorest carbon performers, that you then also blend this with additional positive impact, which is an additional scenario. For instance, that you optimize then the SDG contributors, or optimize then also the carbon solution providers, and so on and so forth. And last but not least, we then make an overall combined optimization that takes into consideration then various other aspects, also like controversial sectors, minimization, and so on and so forth. And then we are plugging at it on various different tracking error steps, as you will also then see in a minute. And we starting from 0.25 tracking error, and then looking at it until the overall range across the overall tracking error range. And then what's important, we are looking at it from 3 different views, because we found in our discussions always that investors said, okay, do I really need to switch to ESG? Is it possible maybe also to optimize the carbon footprint within the traditional asset classes or the traditional sectors or traditional regions? So this was our first approach. We said, okay, let's look at it from a more conservative perspective, where investors want to set the first foot into the door and look at these aspects, but are not yet willing to contribute more to ESG, but they want to optimize and want to get a feeling what can they do in the traditional pond, so to say. This was the first approach. And the second one is that we do a kind of replacement analysis. We take the traditional asset class with all the indices behind and rip it off and replace it via the corresponding ESG universes, the ESG indices across all asset classes. And then that's the third step. We optimize it all together. So we take ESG replacements and then optimize the regional and sector and asset class weightings and look at it. What can we achieve in terms of ESG value against the tracking error? And this is, now directly some of the interesting results for the first step, where we optimize within the traditional pond of asset classes. And what we've done here is to break out now the first scenario, so which is really kind of basic optimization, where we reduce the carbon violators and the norm violators. And then what we do there is to look at it from a regional optimization perspective, where we overweight and underweight EU versus MSCI in the US, or versus the emerging markets perspective, and do this vice versa, high yield versus corporate bonds, and so on. And also then from a regional perspective. And you see here, for instance, for two tracking errors, for a tracking error as low as 0.25, we have for the regional and the sector perspective relatively modest improvements, say roughly 10% can be reduced for a small tracking error with regard to carbon and norm violators, and also roughly 10% can also be the CO2 footprint be optimized. So it's not so much for a small tracking error, but for a larger tracking error, it is really kind of interesting what the results are actually. For the sector allocation, you can, for instance, achieve as high as CO2 optimizations of 35%. So which is quite decent, considering that we are still in a, let's say, traditional asset class world with the totally traditional indices. And also the norm violators can be reduced by quite a lot, by up to 45% in this example. So there's some tangible results that you can achieve, but you have to go to higher tracking errors in order to produce some impact from an ESG perspective. That's quite clear. But nonetheless, it can be done also within traditional asset classes. So the next question is now, what happens when we are completely replacing the, let's say, traditional asset classes with the ESG asset classes? And here's a rolling 12 months tracking error for this replacement strategy. And you see that tracking error varies for this one-to-one replacement from roughly 0.2 to 1%. So it's, yeah, it's varying, but on average around 0.6, which is still quite relatively low, considering that you're making a complete replacement, traditional versus the respective ESG versions. And what's also quite interesting is that the ESG effects can be relatively significant. For this example, you can reduce the norm and carbon violators by up to 70%, and also the CO2 footprint can be reduced by up to 44%, which is, again, considering the Paris-aligned benchmark, it's quite significant. And you can also optimize then the solution providers on top of this. So now we bring this together with the third optimization step. And here's a comparison. You see the comparison against the regional, the sector perspective, the replacement perspective, and the additional ESG optimization on top. And this is what you see from left to right. We are starting with the regional allocation, then sector allocation, then the replacement, and then we have the additional optimization. And this is all only now used for the tracking error of 0.25%. So the lowest tracking error that we have chosen. And you see that the carbon reduction for such a combined optimization, and this really surprised us, can be as high as roughly 50%. So with other words, for a really small tracking error, for entire switch to ESG, slightly optimizing also the regional allocation, but still having a tracking error which is still so low, you can have really tangible ESG outcomes. And as you see, we can also further optimize this then with regard to the one-to-one replacement. And what we do now here on the right-hand side is then to compare this with our, let's say, the utility function that you see on one glance, all the different metrics in comparison. And you see that the ESG optimization function is above on the highest side, the green function, and then you see the comparison against the sector optimization. And you see that for sectors, you can still achieve higher ESG value, but only for higher tracking errors. Whereas for the ESG replacement, you see relatively steep improvements in the first place. And then at later stage, even for higher tracking errors, you cannot, let's say, further improve the ESG footprint. Whereas for the, let's say, one-to-one regional replacement, there is not so much of any additional ESG value that you can achieve there. So this brings me now also to the summary here of the main results, and we have discussed this also now briefly. So there is certainly an optimization potential within traditional asset classes and sectors and regions. I would say it's more clever to do so more on a sector level, but then on a regional level. And in particular for higher tracking errors, that can also make some sense, in particular for a kind of sector optimization approach. But if you really want to produce for lower tracking errors meaningful ESG impact, then you need to switch to a combined optimization. That's for sure. And you can already at really low tracking errors achieve really tangible results like the already mentioned 50% carbon reduction or up to 75% reduction in carbon and norm polluters. For even higher tracking errors, the reduction of the norm rating and also carbon rating violators can be reduced by up to 90%, and also the carbon intensity can be reduced by up to 70%. Yeah, this is really for us also surprising that even for standard indices, it can be as high as these values. And we also then make calculations of where is then really the optimal tracking error compared to your ESG value, and also make the analysis for these various steps. And we would say that already at tracking errors at 75 to 100 basis points, you probably have already found the ESG optimum from the various different perspectives that we have looked at. But of course, for 25 basis points, it is as well quite tangible. So now, before coming to the end, also a brief sneak preview, so to say, because we are continuously updating it. And for our 2022 update, we also plan some nice additions. And as we also have heard here in the morning, that EU taxonomy is upcoming, there is no doubt. So we are also using now experimental data in order to determine how we can also optimize the EU taxonomy quota for such investments, and also how we can also reduce the principal adverse impact from a top-down perspective for these various portfolios. We also integrate additional aspects like the SBTI alignment. So many different things where we also have now more data available also for larger universes. So that's something that we plan here for the next couple of months. So hopefully you stay tuned, and looking also forward to these results then in the next couple of weeks when we are also reporting this. And last but not least, the big question is, how can we use it? It's not just for mandates, but we are also applying it already now for the various funds in our multi-asset portfolios and for our ESG strategics family. And with this, I'm handing back to Frank and looking forward for questions or any comments.
Gunnar, thank you very much. And first of all, are there questions here in the room in Frankfurt? No, not yet. Then Fabian, are there any questions from the online audience?
Actually, there was a question from the online audience. If you put such emphasis on optimizing tracking error, is there not the danger that ESG goals will be missed or not fully met? But actually the same person later said, due to the explanations following my questions, he withdraws the question because you answered everything, I guess.
Perfect. Okay, good.
Gunnar, thanks a lot.
Thank you.
You can directly have a seat at the ESG panel session. And I would like to ask Thorsten and Barbara to come